Now this can be done when the expiration dates are the same. This can be done where the put is at a different expiration than the call. This can be done when the put is below the stock price and the call is above, or the call and the put are both above. Various different structures that can be used here for a calendar collar. But Paul's been seeing ones that have an upper and lower break-even, a chance to lose if the stock moves up and a chance to lose if the stock moves down. He wants to know how he can find these calendar collars, where the call and the put have different expirations, that do not have an upper break-even. Now, unfortunately, there's no real answer to that. And the first thought is to simply use a call that's further out of the money to give a wider increase in price as the stock moves up before the obligation of the sold call kicks in, limiting further upside. Anytime you look at a calendar spread, a standard diagonal spread, a horizontal, or even if you're looking at a calendar collar where you own the stock, the upper and lower break-evens use the Black-Scholes pricing model to calculate where the long option might be priced at short-term expiration. So depending on the volatility of the long option, if it's too low, for example, if the stock moves up, the put might lose value too quickly with the low volatility or have a low calculated value where you're not getting much back and you've capped the gain in the sense to a price that is below your total net debit into the position. That is part of the problem. Now, Paul had some follow-ups on that. He's been trying calendar collars with net premiums of 0 or more. And in any case, his experience with calendar collars has been a high probability of not losing money, but with profits much smaller than the maximum possible profit. That's another effect of the calculations that have to be used at the time you enter the trade. If the implied volatility of the put option drops while you're in a calendar collar, that theoretical value you're expecting in the return is not going to be as high simply because the long option didn't retain as much value as you initially expected due to a shift in volatility. That can happen in a diagonal spread, a horizontal calendar spread, even a calendar collar. Now you're considering trying long collars, standard structure with larger maximum possible losses. Okay, the problem has been finding these long collars with maximum profits larger than the maximum losses. You only find that with out-of-the-money collars. And the issue with the out-of-the-money collars in this case is that it might not match your trading goals. In other words, you have such a low probability of getting the maximum profit that's larger than the maximum loss, it might not be worth it. And then finally, probabilities of maximum profits and of maximum losses tend to be similar. That's true. This leaves no edge for traders using collars, meaning that you have to be right more often than wrong. And that is correct, in the sense that in past webinars, you've probably heard me say that I do use collars in my personal portfolio. Standard collars, same expiration. I've had the benefit or the luck to be right about 67% of the time, which still makes that profitable in my account. I wouldn't have been profitable had I only been right 50% of the time. Okay, that's sort of the trade-off. Now, a lot of names just thrown at you, a lot of ideas and a lot of discussions, but let's keep it simple here. And we're going to navigate over to Power Options. And we're going to just quickly go through this, some of Paul's concerns and some of Paul's ideas, and take a look at some of the things that might be done. So first things first, we're here at the Power Options suite of tools. Uh-oh, something happened there. Let me just pause that. It looks like it kicked me out, so let me just log back in. My apologies there. But what I want to look at real quick when we get on is we're going to take a look at just the standard collar structure as a starting point. Then we're going to look at the issues of making it a calendar collar, and then we're going to discuss this idea of the upper and lower break-evens and some management. It'll be kind of short, but it'll also be very useful. Now, many of you might be familiar with the general covered call structure. Many of you are probably familiar with the collar structure. I'm just going to take Starbucks because it's a position I'm in right now as a married put trade. And stock closed today at 70.62. If I was opening a standard collar, I'd consider going maybe 14 days out, maybe 21 days out in time. Buy shares of Starbucks at 70.62. And I'm probably going to look to sell a just at the money, maybe 71 or maybe a 72 strike. I'm going to take a look at the 72 strike first. All right, so let's go ahead and build that. We're going to buy 100 shares of stock at the current price. And I'm going to sell a 72 call for only 64 cents. Okay. As a standard covered call, a standard buy right position, this would give us a return of 2.9%, about 3% for 21 days. That's a pretty good target. But now I'm concerned the way the market has a little hesitation today. Although I like the covered call structure, maybe I want to lower my cost basis down a little bit. We might do a different structure if it was just a covered call. But normally in a collar, I'm selling the at or just out of the money call, and I'm going to buy a deeper out of the money put with the same expiration. This is what we call a standard collar. And I'm going to look for a put option that's lower in price, so I still take a positive net credit, but where I'm still not taking too much of a loss on the trade. And too much of a loss to me is above 4 or 5%. Let me start actually with the 67 put. Sell the 72, buy the 67. We've got a 5-point difference here in our standard collar. We're not going to have that 2.9% return. It's going to drop to 2.5, and we have a max loss of 4.6%. Now, I could increase the benefit of this trade by probably selling the 71. It would give me a lower risk because more premiums taken in, and it might not give me as high as a potential return, because remember that max return is if the stock is above 72. I'd have to get $1.66 for that 71 premium in order for it to make sense. Now let's start from the back of Paul's comments looking at this structure. This, by the way, is a typical structure that I use in my portfolio. I look for a gain of about 2 to 2.5%, maybe 3% if possible, without taking a risk of more than 5%. This is pretty close to a 2-to-1 risk-reward ratio. And that was the direct comment that was made by Paul. That in this structure, unless I do see a move up to 72, I'm not going to get that maximum profit. Okay, that's at assignment. And if it was above 72, I'd let it get assigned. I'd let the put expire worthless. And I'd look for a new collar 21 days after that that matches my goals. But with this 2-to-1 risk-reward ratio, I'm going to have to be right probably 62, 63% of the time in order to profit long term. And it isn't to say I'm going to make the maximum profit when I'm right. And it isn't going to say that I'm going to take the maximum loss when I'm wrong. Sometimes it will be in between the strike prices, and I'll have a small gain or a small loss. But Paul brought forth the true comment and saying the probabilities of maximum profits and maximum losses tend to be similar. I'm probably at about a 42%, 45% probability the stock will be above 72 and I'd make the maximum profit. And there's probably somewhere along the lines of a 40, 41% probability stock could be below 60 cents, probably less, that's probably about 35%, where I'd take the maximum loss. But remember, the maximum loss is twice the gain. With this structure, and even if I limited my risks to only 50% of the max loss I'm allowed, Paul is absolutely right. I cannot have a 50-50 win-loss ratio and make this work for me. I'm going to need to be right 65, 66% of the time in order to profit long term. The benefit of this structure is that for investors who trade covered calls, where you might be losing as much as 7 to 8% when the stock slides. Here I have a maximum loss of 4.6. The stock could fall 20% overnight. I can't lose more than 4.6%. In a covered call, if it drops suddenly, even if I have a stop order, I get triggered at that 20% loss. If I use a stop, the market gets whatever it can. Even if I set a 5% stop, if it's down 20%, I get filled at the 20% loss. If I'm only making an average of 2% on the way up, I've just wiped out 10 trades. With the collar, it's guaranteed. Okay, so that's one of the main benefits over a covered call. Going back to that just covered call concept, even if I was at the money or slightly in the money, when the large losses do come in, and you wipe out more trades, you probably need to be right 73, 75, maybe 78% of the time, depending on your structure, in order to profit long term. This structure doesn't solve all the problems of the covered calls. The structure by itself is not an automatic winning structure, because I know I still need to be right 65 to 66% of the time. Okay, now, what are some of the things that we could do to adjust this? Well, number one, this doesn't have an upper and lower break even because we're not talking about the calendar collars yet. But I mentioned I could reduce the risk to reduce the profit by lowering the strike. If I use the 71 strike, I'm not going to get as much appreciation, but I'm going to get 40 to 50 cents more premium. But I'm not getting assigned at 72, I'm at 71. So now I take the risks down to 4%, but the gain also goes down to 1.7. Is there a way to construct a standard collar that we're talking about here where the maximum profit is greater than the maximum risk? The answer is yes, but the probability of getting closer to that maximum profit is really small. This would be known as a debit collar or an out-of-the-money collar. We take the same stock at the same price. We'll instead go 21 days out again, and I'm going to buy a 70 put right at the money, and we're going to sell a 73 call. Let me see if this works. Okay, so we're only getting 36 cents. We're going to lower the cost basis down to about 70.30, and we have a 70 put. Oh, I'm sorry, no, we're going to pay a debit. This is actually going up to 71, so we're only going to be losing $1 on this position. I've reversed that in my mind. I apologize. So this is a debit collar. I'm actually paying an additional 60 cents. So now my cost basis is 71.18. 70.62 plus that additional maybe 27, 26 cents. However, if I'm right, I make 2.6%, and if I'm wrong, I only lose 1.7. This is the structure, the debit collar that could get you a higher return as opposed to the risk. Where's the problem? The problem is, in order to get the maximum profit, the stock needs to be above 73, meaning more often than not, I'm going to be in this range, or maybe even at the maximum loss. This is about a 42, 43% probability. This is about 20 when you first structure it. So you'll take more losers than winners with the hope that that balances out long term. I don't use this personally. I don't think it's a good approach. In my opinion, this debit collar. I've had investors do it over time, and I've had investors, some financial advisors actually sort of use this structure. It's not something that I use typically in my portfolio. One of the tricks about collars is they're so dynamic. We can do them multiple ways. We could do these out-of-the-money collars. We can do in-the-money collars that offer a very small return with a risk of maybe 6 or 7%, but now you're back to almost needing to be right 70 to 73% of the time to profit long term. Okay? All right. Now, let's talk about some of the issues Paul's been facing with this other idea. As we know, the tenet of options is that I would like to sell shorter term, week by week, 2 weeks out, month by month, to get a better annualized return. But when I'm buying options, the reverse is true. I want to be buying further out in time to have a lower annualized cost. That's one of the concepts of the calendar collar. So let's go a little bit out of the money again. We'll go to our March 21st. Let's stick with that 72 strike that we used in our first example. But instead of buying a put in the same expiration month that's a lower price, let me roll out to April, maybe June. I'm going to stick with April for the time being. And we're going to go with a 67.5 put for $1.03. All right, so now we're only going to get 60 some odd cents, 66 cents here for the call. But it's short term, 21 days out, and we're 60 some odd days out here for April. So I could technically have 3 right cycles against this stock plus 3-month output combination. Now, here's the trick. This one doesn't do what Paul had mentioned. I'll show you an example of that. This structure here ends up with a cost basis of $71. 70.62, we take that down by the call, then we add another dollar in. Okay, I'm guaranteed that the worst I can do is get 67.50 back, so I've got a risk of 4.9%. And here I have a percent return at the first cycle, March 8th expiration, 22 days away, 21 days away, of about 2%. When I enter this trade, it's because I'm planning on rolling or adjusting this position, maybe having it open for 45 to 50 days out in time. I'm not just looking for this one return here. Otherwise, if I was looking for this one return, what would I have done? I would have sold that March 72 call that we did here, and I probably just would have bought the March 78 to keep my risk at, 4.6 with a potential return of 2.5%. If my thought was the stock was going to be above 72 in the next 21 days, I would have stuck with the standard collar with the better numbers as opposed to doing the calendar collar, comparing them side by side. But if I'm expecting a little bit more growth longer term, 50 days, 60 days out in time, this might be a calendar structure. But where's the problem? Now this one doesn't do what Paul had mentioned. Some of these calendar collars where the put might be too expensive or have too high of an implied volatility, where we cap the gain here to the upside, which takes away the positive delta on the stock, he may cross into another loss zone if the stock goes up to 77, 78, 79, or so forth. Okay, that's the double break even, the upper and lower break even. This one does not do that, and it's because I gave a little bit more breadth on the position to allow some intrinsic to move up, but it does take on almost a 5% risk, which I don't think matches Paul's goals. Because here I'm still at that 2-to-1 ratio. I still need to be right about 67, 68% of the time to profit long term. As we approach expiration, if the stock starts to move up to 72, I'm going to be tempted to roll this call out up to 73 or 74, maybe to March 15th, maybe to March 22nd, depending on what matches my goals. Okay? But to Paul's direct question, the structure of the trade, let's say, why would I only want 60 cents? Let me go to the 70 or the 71 call and get a full dollar in. So instead of selling the 72 for 60, I sell the 71, March 8th expiration, 28 days out in time, 21 days out in time, for $1.18. But it's not $1.66. Meaning that when I sold the 72 for 66 cents, if it was above 72, I get that dollar appreciation, plus I get the 60 cents. Here, I don't get the extra dollar appreciation, and I only increased it by 50 cents. Still a good structure, though, in the sense that it doesn't give me an upper break even. But as you get closer to the current stock price, and depending on the structure and the volatility of the put, that's where you can see that upper break even. I'll see if I can find one for you real quick. A simple search in our collars. I've created, of course, a collar screen that's similar to what Paul was looking at here. I'm adding long collars. Give me 1 second. I know the screen's just staying where it is, and that's because I paused it. All right. There we go. All right, so let's go to long collar and let's go to search. And I've got a default one here. Where's my default? Different month standard collar form. Right, so some of these don't have an upper and lower break even. Let me try this one here, 86 to June 85. So I'm going to sell a 22 March 60, so this one doesn't get that upper break even either. Okay, so Nike's got some volatility on it. Maybe Caterpillar's one, 137, that looks pretty good. Now, this one still has, doesn't have the upper break even, I apologize. So there are ones that can do that, and it's because of the structure or because the calculated value of the put option is going back to a negative value. See, this one's coming close as we go higher up in price. If it gaps up to 72, 73, we're giving a lot away from the structure there on that calendar collar spread. Okay, so unfortunately for Paul, as I mentioned, I don't have a great answer as to how you can find positions that don't have a break even. A lot of the ones on my default search are in this fashion, excuse me, where they typically don't have an upper break even, though I did find several the other day. The key, of course, is the structure in itself to do that. Now, going back to Paul's question, we already covered that when we talk about the standard collars and so forth. This here I don't think is so great of a risk-reward ratio. I'd only do this calendar collar with the plan that by March 8th, I didn't think Starbucks was going to continue much above $71. I need it to be right in that window, pretty much just as I do with a diagonal spread. And whenever you sell a call, in a covered call, in a collar, in a standard collar, or in a calendar collar, in a diagonal call spread, you're kind of saying that I think the stock's going to be within plus or minus 1% of this call strike price. If you think it's going to move up quicker, a standard collar might be better. Just take assignment and take the profits. This structure gets complicated because it is based. This max return is based on that theoretical value of the put option if the stock is trading at this price on March 8th, 21 days away. A lot can change on the stock and on the options between that time period. So let's say that our stock was trading right at $71 on our near-term expiration of March 8th. Our put has a volatility of 0.20. It would drop 47 cents, but we'd have the gain here. There's your profit of 108 in this example, or 1.5%. For whatever reason, the implied volatility of my April put drops to 0.15 because the stock was moving up and it was more consistent. Now it's going to be less. We can't really estimate the change in volatility of what's going to happen in the next 30 days. The max return you see on these calendar collars and diagonal spreads even is based on the theoretical value of this long option. The stock is trading at any price at the short-term expiration with the assumption that the long option volatility would remain the same. If it fluctuates against you and the volatility drops on that long option, you're not going to be at the maximum profit you'd expected. And Paul, I think that's the problem you've been running into with some of these calendar collars, as you mentioned. That you have a high probability of not losing money, but with profits much smaller than the maximum possible profit was your comment. And I think this is the reason why, the volatility flux. And this is also something that affects calendar spreads, diagonal spreads, and horizontal spreads, because the expected return can only be projected based on a theoretical pricing model. Theoretical pricing model takes into account the implied volatility of the option to calculate its theoretical worth. As that changes, it's going to adjust what the potential maximum profit is. It's not as straightforward as a debit spread, a standard collar, a covered call, because both can fluctuate. And the worst thing that can happen in a diagonal spread, or probably in a calendar collar, is that for whatever reason, in the short month before you hit expiration, the implied volatility spiked from some bad news, but your put option that's 3 or 4 months out actually loses implied volatility. It won't happen that often, but if it does happen, then what happens? Your put, or the long option you have further out, decreases because the implied volatility dropped, and the buyback cost to close the short option that's near term increases against you. So that's why in some of those searches for positions where you can have 2 different expirations, we show the implied volatility range, implied volatility ratio, so you can look for positions where your short option IV is greater than the long option IV to make sure you sort of have the structure that you want. But that doesn't mean it can't change. And when it changes, that's what starts to hurt the position. So Paul, I got a little bit more work to do on your question, but I wanted to address some of the issues that we didn't get a chance to discuss today via email. That sometimes when I look at a calendar collar, if my expectation is the stock's going to move up or it's very strong, I'm more tempted just to use the standard collar and look for the expiration profit, rather than try to hold it longer term and continue to sell week by week against it and manage and manipulate it, because I lose money on the calendar side if it does move up further than I expected, whereas in the standard collar, I'm taking the maximum profit and getting a higher probability that I'm going to keep the maximum profit as I get closer to expiration if the stock moved up as I expected. All right. So I know we're going to have further conversations on that, Paul, and I look forward to it, and I'll try to put some ideas together too for ways that you can filter better for positions that don't show an upper break-even and lower break-even as well. We'll always have a lower break-even in this structure. Okay, now let's move on here. Marvin was the first question in, and it's related to something that we just put up today. But Marvin says, how do you handle selling calls against a stock and the price blows through the strike long before expiration? All right. I actually haven't posted this on the site yet. One second here. Rolling covered calls is what we're talking about. And I just put together a 15-minute video, and it was posted to our YouTube channel. And as I mentioned, unfortunately, I haven't added it to the site yet. So if you go to the YouTube channel, it's just youtube.com/poweroptions. I'll send that there. There you go. I think it's just or just search for Power Options on YouTube. Here we go. All right, so I just pulled, this is, my channel here. I'm going to pause it as soon as it opens, but we just put up a 15-minute video on unwinding a covered call. Okay, and so it's real quick, and essentially what it is, Marcus, is we took a look. I don't know if I have it on this one, but we took a look at a Starbucks position. Okay, it's not there. Where on or around January 24th, we got into a Starbucks call. Well, we had a cost basis. I'm sorry. Let's start from the beginning. How about that? 64.75. And roughly on the same day, I could have sold an in the money and at the money or out of the money call. But what we looked at is selling the just at the money 65 call on January 24th for 95 cents. It's roughly 22, 23 days out in time. Okay, so my original expected covered call return here was 1.9%. So I was looking for about a 2% potential covered call return for a 22-day time period. First thing that's important is that I never would have entered this trade if I wasn't comfortable with this return for my trading goals. Okay, so that's number one. That's the most important thing. And it sounds silly to mention that, but a lot of times I talk to customers that say, hey, I really like this stock XYZ. I sold a call that only gave me a small premium, but I thought it was going up, and now it has gone up, and how should I roll it? Well, it was only a 0.4 or 0.5% return. And if it didn't match your trading goals, you shouldn't have entered it anyway. Okay, you should have waited for a better opportunity. But in any case, that's not what we're talking about here. So we go to the position analysis. Stock's at 70.71. We sold to 65, so we're $5.70 in the money. And what we took a look at in the video is, of course, using the portfolio tools, I could liquidate right now for 1.4% or let it get assigned for 1.9. And that was for 22 days. It's important to remember the trading plan. Now, a lot of people suggest that we should only roll for a credit. I'm not necessarily on board with that, and here's the reason why. When I originally sold this call, and you'll see more about this in the video, this 95 cents against the cost basis of 64.75 was all time value because I was right at the money, a little bit out, and it was a 1.5% time value, and that extra 0.4% comes up to the appreciation of 65, that extra quarter. Okay, but it was a 1.5% time value for 22 days. Well, now the stock's 70.71. I know I can make 1.9% right now. This is my liquidation, but it's going to cost me $6 or so to buy to close that call. It's $5.50 when we were doing the webinar, or that short video. So if I roll out to this March 71 call for $1.10, I am going to increase my cost by $3.95. But the potential return goes up to 3.3%. In the webinar, it was actually 3.9, which is why I did it. I went up from 1.9 to 3.9, which was a gain of 2% for another 22 days. I'm still within the same prospect. I'm still getting the same close to 1.4% time value of 110 against that $70.70 cost basis where the stock is now. So this is still in my target zone. I'm collecting 1.4% time premium. It would have gone up. See here, I don't know if I do it. If it's only 1.4% gain for 22 days, I don't know if that's in my target. I probably want it, again, as I mentioned, 1.7, 1.8, closer to 2%. This isn't here. So maybe I'd go out to the March 7250, 28 days away at 4.9. But now the premium's only 1%. The time value is only 1%. I don't think that matches. So when you roll, you've got to roll to your plan. Now this isn't a huge move. It's close to about 9%. It's pretty big. I let it go up gradually. Normally what I would have done is when the stock hit 67, I might have rolled from the 67 to the 67.50. Maybe same expiration, maybe another week, but when the stock got up to 67 or 68, I might have rolled up to the 70 call, and right now I'd probably be out to the 15th of March, and maybe even the 22nd of March, rather than looking at the 8th, because I would have rolled continuously in that structure. But I used the portfolio tools to determine what was my original trading plan and where to go next. Now, because of the cycles here, I don't see any opportunity. Here's a one to go to the April 67.5 call to get a small debit of only 65 cents. I get a new premium of $4.40, but now the return is only 3.2% for 62 days. That's nowhere near my trading plan of that 1.8, 1.9, maybe 2% for 20 days. I'm only getting about 1%, if that, and I'm increasing it by 62 days. It doesn't include the 22 I've already been in. So that's not necessarily what I want. The only opportunities to roll for a credit don't match my goals. Okay, and what do I mean by that? The Starbucks structure, and you might have different experiences here with your stocks and what you're trading, but the expiration series goes out to June or July. The 70, 72.5, 75 calls are nowhere near the $5 or $6 premium it costs me to buy it back right now. Okay, they were close, but not quite. See this here, the 70 is at $4.40, but it's already in the money. Yes, I took in 95 cents initially, great. I got to pay back close to $6 from $1.20 down, and then I get $4.40 back. So it's not really, I'm sorry, the 95 cents didn't counter that. I'm still at a debit of 30 cents. It's not there. I'd have to go all the way out to January. And the 72.5 is about 5 to 5.75. The 70 is at 6.45 to 7.20. So this would lower the debit. I'm out 338 days, 337 days out in time, and the return only moves up to 10%. Okay, so we can look at it real quick. It was 10.5% when I did it the other day. It's going to be higher now because the buyback costs went up to 6. So the midpoint's going to be lower. All right, so we're going to buy back our our February 15th today, get midpoint. We're going to sell the January 72.50. This puts me up to 11.4%. Using midpoint, it's actually higher than it was when I looked at the webinar. But what's the problem? It's an 11% return, 11.4% return for 336 days out. And some investors tell me, well, it's okay to roll here for the credit because if the stock pulls back, you can buy it back more cheaply. This is going to retain its time value for a long time unless the stock really drops and moves down to $58, $57, $56 per share. And at that point, I don't think I want to be in the stock anymore. It's not doing what I want. I'm losing more on the stock than I lost on this roll for the covered call position. So there are ways to manage it. The Power Options tools will help you. Check out that video on YouTube there regarding rolling the covered call position. Okay? In this case, I could have rolled to March and it would have worked for me. And that's what's shown in the video. If when I rolled up to that March 8th position, 21 days out from today, I'm keeping that same strike, same time frame, looking at the 71 call. Yeah, so the return is about 4% if I get midpoint price to buy to close my call. So what am I doing? I've just kept the same potential max return, moved it up 2.1% for 22 days, right? I'm still in the target for my trading plan. If it had moved up to 80 and it would have cost me so much to roll the position, and rolling up to the 80 call only gave me a 1.5% return, for example, increase from what I have now, I wouldn't do it. I would just take assignment on the first position, make my 1.9%, and then decide, do I want a different position? Do I want to trade Starbucks again? I probably wouldn't. I wouldn't go back in necessarily buy it at 80 and sell it, because it's the same thing, essentially, the same change in return of just rolling the covered call, okay, if you held it all the way to expiration. So we do have other education on the site on rolling covered calls. I will point you to those, but the portfolio tools will greatly help you see which rollout opportunities, where we do all the math for you, what rollout opportunities, are available, where we do all the math for the new calculated percent if assigned. You see the time frame, the probability. But yes, most of the time, it is going to increase for a debit. If the stock runs against you and you try to roll that covered call and you want to roll for a credit, you're probably going 6, 8, 10 months out in time, and the new return might not specifically match your trading plan, in which case I would not roll. Okay? If a covered call roll opportunity or a collar roll opportunity doesn't keep with my trading plan for the return or time value for the amount of days I'm in the position, or I'm going to be in the position, I will just take assignment, be happy with my win, and move on. Danger, of course, is if you had a position that fell against you and you rolled down and then it snapped back up, you're going to risk getting assigned for a loss. Now you may need to roll that 3 or 4 months out in time to try to convert it into a winning position, but you're going to be sitting on that capital for an extended period as well. Okay, so check out that little 15-minute video I mentioned on YouTube, Unwinding a Covered Call. And there's also a blog article Ernie recently wrote that's available on the web blog that you can take a look at as well. I'm just scrolling through something here. There we go. Okay. All right. Sam, I think, had a connection problem and might have disappeared there. Oh, one real quick more thing there as we're talking about it. I apologize. Let's go to the, shoot. Let's go here. I got to add covered call. My apologies. So I got bear call. There we go. Some other resources for us. You should just go to the main covered call tab. There's some Learning Center information here. Covered call tutorial gives some examples of rolling real covered call examples. It's a little bit older. Follow up a covered call position, management principles discussing there, and of course rolling covered calls. So, and I'll try to find some other detailed information over the past couple months of webinars we've done, which there are. I'm sorry, let's just go to free webinars here now while I'm there, and go to option strategies. It's a little bit older. Oh, sorry, folks. I think I just passed it. I'm sorry, there's one in here on manage your cover. Ah, there it is. I'm sorry. 12/16/2016, managing covered call positions. It's a free webinar. Just go to powerup.com/webinars.asp. Scroll down on the option strategy section and check out managing covered calls. Thoughts on trigger points, when to roll your calls, and how to roll your covered calls as well. I'll give you more insight, and then we can talk about it next week. Send me an email or give me a call. Schedule a coaching session, and we'll talk about some of those covered call roll ideas. But if you're tracking it in the portfolio, you'll be able to go right to the position analysis and see some opportunities and what matches your trading plan. Sam's question, I'm gonna answer, but I'm not going to be able to show examples of this. Sam's question is, how would you buy options cheaper than intrinsic value, and what are the benefit of them in a debit spread? I've never been able to buy a call for less than intrinsic value or buy a put. Even if they have a wide bid-ask spread, the market maker always forces at least intrinsic or a little bit above. I've never been able to do that. I've never really tried because I know I'm always going to pay 5, 10, 15 cents closer to the midpoint, which is usually 20 to 30 cents above intrinsic, depending on which time frame I'm going. So I've never been able to buy a call below intrinsic. Market makers tried to catch me selling a call below intrinsic because he wasn't giving me a fair price, but I didn't let that happen. Okay, let's see here. Rudolph. Some stocks I own and sold covered calls went underwater. Okay. Besides continuing to sell covered calls, is there any idea on how to get additional income to reduce the net cost of the stock to close the stock position at a little loss or maybe a profit? Okay. Direct answer is no. And what do I mean by that? Any concept of selling more premium, there are some ways you might be able to do it, but it's not as simple as just selling premium to further lower the cost basis to help you get back to break even faster. Why? Because anytime you sell something, you're entering into another obligation. Okay? So I have a covered call. This is not a real position. It hasn't been there yet. I could take a bunch of stocks, but I'm just going to use this other one. T-Rex has been on a great run, and it dropped 5% today. Earnings were the 14th after market, so before this morning. So I've watched T-Rex go from 66 up to about 77. I think today it pulled back to 72. It almost came right back to where it was. Yeah, it did. But let's say the other day I did a silly thing. Or let's say it was a different stock, and let's say that I bought, you know what, let's take a different stock. Let's take something realistic. Stocks that fell today. TrueCar, down 254, 25%, probably really poor earnings. Let's take it. Let's take a look first at the option chain for TRUE. I just want to look at the call chain very quickly. And we're going to go back a day or two. So it's 1024. It's pretty good. It was up 18 cents. So we're going to take yesterday's numbers. TrueCar at 1024. Let's say we sold March. It only offers March. 11 call for 40 cents yesterday. Okay, 1024. Well, it's 50 cents midpoint. I know it's a smaller price stock, but we'll just use this for our example. All right. Now, let's go to our custom spread tool again. Let's just build that spread if we had covered call, if we had entered it yesterday. Adding in the stock. Let's keep nice round numbers here. 1025 for the stock. I'm going to sell a March 11, just out of the money call at the time, for 50 cents. Midpoint at close. All right, so the stock is now down to 770. We're at a pretty significant loss on this position. Sure, we had a cost basis of 975. We're essentially down 275, or about 22, 23% on the position. Okay, so now I want to think about rolling down this call. And it's going to be complicated because I'm going to buy back the 11. It's going to be not much. I keep the same expiration. Well, I can't go to the 7 because I can't risk getting assigned at that price. I can only get 30 cents here. Again, we go out to July, maybe I get 80 cents here, but remember, I'm down $2, okay? But anyway, let's go ahead and do that. I got to roll out to July to get anything back. We were at a loss of about 25, 27%. Here we are at a loss of 8.7%, and this is only a reasonable roll if I feel the stock's going to stay below 8. And sometime in the next 140 days, I can buy it back cheaply and sell another call that would probably still be 180 days out because I've got to cover this 104 loss on small premiums. So is that to say there's nothing that can be done? Not really. We take in 50 cents, which lowered our cost basis down to 975, and it's going to cost me about 10 cents to buy it back. Okay? So I buy it back now for 10 cents. And that puts my cost basis at 985. Okay, so we lower the cost base here. We're going to buy it back, take 40 cents here. I got a cost basis of 985 on a stock trading at 770. first thought is one of our tools. Let me go back. I apologize. So where I was going with this, Rudolph, is to say, okay, you want to sell more premium to try to get back to break even. Now we buy this back again, I'm sorry, and we sell your July, and just to do is kind of a hedge there, okay? On a stock that's falling and it has negative value. We know we're locking in a loss of maybe 8.7%. We have a cost basis now of only $8.97. You say, well, can I sell another call? No, that would put you in a naked call position. You'd have to put up the margin to cover that, so you're going to increase the risk. And if you just sell simply another call, if I sold 2 here to create a ratio, you're going to have infinite risk to the upside and not get to a positive gain here. Okay, that's not going to work. I say, okay, well, I'm bullish. I think the stock's going to recover. I wouldn't want to be in the naked call. Let me sell a bull put. Okay, well, if you sell a naked put, let's go out to April. You sell a 7-strike put, well, that's nothing, 25, 35 cents. You could sell the 8 put, but remember, now you've got to put up the margin to cover the cash secured put. So this is what's known as a covered combination. You do lower the risk, but now your total requirement is double. Your maximum risk is nearly doubled. It moved up from about $900 to about $1,600 because I have to put up the cash to potentially cover the obligation of buying another 100 shares at 8. And then you say, okay, well, I want to do other premium. I don't want that margin. Let me go out in time and do a bull put. Well, you get about another 45 cents. But you still have to cover the $2 margin on the bull put. Sell and buy. Okay, so now I've got a rolled covered call with a bull put spread. My risk increases again because if it continues to fall, I'm not saying it falls below 5, but if it does, you take the full loss on the bull put plus the extra loss on the covered call position. Okay, now, what else can be done? So I buy to close this call for 10. I have a cost basis, what did I say, of $9.85. Well, we offer another tool here called the stock repair. Now, because of the premiums, I don't know if any repair is going to be available. What this does is it helps me try to build a ratio spread to get back to break even faster. So I have a cost basis of $9.85 on 100 shares, and this, of course, works better with smaller price stocks. It does find a March repair, interestingly enough, for me. But these are only debit repairs. What does that mean? The system tried to build a debit and a credit repair for us. It could not find any credit repairs at this time with our cost basis of $9.85. Okay? So there is a debit repair where I could buy a 7-strike call for March, sell 2 9-strike calls, and I'd have a debit of 85 cents added to the position. But now my break-even drops to $8.85. How is that possible? Because what we did, and this would be speculating that the stock moves back up above 9 or $8.85, you create a ratio call spread where if the stock moves back up, goes to 8, goes to 8.50, this long call you got is going to be worth $1.50. If it goes to 8.85, it's going to be worth $1.85. So you've got the regain in the stock back up to 8.85, another $1.15, $1.85 value on the call. Your 9 calls expire worthless. It's 2-to-1. This is a covered call, 1 short 9-strike call for no real premium, with a bull call debit spread at 7-to-9, a 2-point spread that cost $1, really 85. Okay, so that's what you have, and it helps you get back to break even faster. But this is still requiring a significant move in this case. Another concept you might want to consider, depending on your capital. Okay, so we talked about what would happen here in our position if I tried to roll the covered call and then sell a naked put to get more premium. The risk goes up as well as the margin requirement. The additional margin requirement increases the risk. I still have the money in the covered call. Now I have to put up the money for the naked put. Rather than put up the margin requirement for the naked put at 7-to-8, let's buy another 100 shares of stock, if you have the capital, at $7.70. It's not always a good idea to throw good money after bad. But remember, after I buy back the call I sold, I have a value of $9.85 for my stock. So bought it at $10.25, took in the initial premium of 50 cents, paid 10 cents to buy it back, so we're at $9.85. And we add 770, buy another 100 shares. So now my average cost base is going to be $8.77. Let's call it $8.78, okay? So I do that, and now go to the stock repair. I have 200 shares at $8.78. Okay. Unfortunately, still no credit repairs on this, but look, we could still enter some of these debit repairs even out to April, and the break-even's only at $8.32, $8.27. Sometimes this is a more efficient way than just rolling down the position, okay? It does. A comment came in from Mark. He says, on the Power Options platform, on the debit repairs, the column header should indicate minus. Well, yeah, it's a net credit. It's a minus net credit, which means a debit, because the column here is a net credit, so we're showing a minus 35 cents, minus 85 cents, minus 75 cents, Mark. That's to denote that this is a debit repair rather than a credit. Let me just do this. This is not related to the conversation. Wow. Okay, let's do something else here. Let's take T-Rex. Ended at 76. Let's say I have a cost base of 78 for 100 shares. Okay, so here's the credit repairs, and you see they show up as a positive credit because the column is listed as net credit. So if the column's net credit, if it's done at a debit, it would show a negative value. Here we're showing the positive one as well for credit repairs, because this one we finally have credit repairs on the position. Okay. All right, so to go back to Rudolph's main comment, anytime you try to sell more premium on a covered call position, whether you try to create that covered combination by selling a naked put, you've got to put up the margin, you're going to increase the cost. You try to sell extra calls, well, you're going to have a naked call, and you probably don't want that. If you do a bull put spread to generate income, or maybe even a bear call spread in addition to the call you sold, you're going to have to put up the other margin requirement to do that. A debit spread doesn't take margin requirement, but you'd be paying extra as well, so it's going to increase the risk. So I think it's better to try to evaluate the stock repair tool here to see if you can find a ratio spread rather than just rolling down the call. Simulate what your cost would be if you close the call you have open, where you'd be right now, and see if you can build the ratio call to help you get back to break even faster. As before, if you go to the webinars page, powerop.com/webinars.asp, under the Options Concepts section, there's a full webinar on Manage Your Broken Position. And we talk about the alternative methods for managing a stock position that's fallen in price, a covered call position that's moved against you, and managing a sold put that's in the money and the stock's been put to you at that lower cost basis, the stock's falling, and more. But that first 20 to 30 minutes on managing the stock position that's fallen or the covered call position that's moved against you is going to give you more insights into the stock repair tool, how to use it, other ideas in addition to using the stock repair tool, and maybe other ideas in addition to simply rolling down the covered call consistently, hoping it doesn't get stuck. And Rudolph, I don't necessarily want to put this out there, but you made the comment, so I'm going to say it. And you said, thanks, Michael, I have so much to learn. Right now I am depressed. Don't be depressed. It happens to the best of us. I know it's depressing. We wanted a win. The stock's still moving down. Later on this weekend, send me an email with your specifics. I cannot give you direct trading advice, but I can absolutely give you a second pairs of eyes exactly on your position. This is what we just showed with the custom spread tool. I'm sorry, the stock repair tool. It is an advanced concept. You're not used to ratio spreads by buying one, selling two, and then even if you are used to ratio spreads, you've seen them once or twice, you're not used to seeing how they can benefit inside the structure of owning the stock. We are creating sort of a covered call and a bull call debit spread. It's a hard concept to grasp right away, and as you heard once or twice in the conversation, I got tongue-tied thinking about, oh yes, well this is a debit, not a credit, and why would I want the credit instead of a debit? So when you look at a repair, this one's actually really good. If it was real, I had the stock at 78. It's only down a couple points, so I could probably just sell a call and make that back. That's true. But you see how this ratio repair gets my break even back to lower than where the current stock price is. We bought one July 75 and sold two 80s against it, and this got a credit. We took an 11.20 and paid 8.90, so we get $3 lower cost basis, which takes care of the loss anyway. But the potential, if the stock moves back up, even if it stays right where it is, I'm going to get $1.76 back for this call that I bought. And this is not a naked call, okay? What this is a covered call, because you have 100 shares of T-Rex with a cost basis of 78, and we sold an 80 call at 560. And combined with one bull call debit spread. Both short calls are covered. One is covered by your stock, one's covered by the long call, but you're getting the benefits of the bull call debit at a credit to help you reduce the cost basis. This is just numbers thrown together. This is kind of a ridiculous repair because you're right. I'd probably just sell the 75 call in this case or the 80 for 560, and I'm already back to break even. I've lowered my cost basis enough here to where my cost is only $72 on a stock trading at 76. So this repair would be unnecessary, but it gives you a better illustration of why it gets you back to break even faster, because this call is a second security. So as the stock's moving up 1-to-1, this is also gaining with probably a delta of 0.6 or 0.7. And these two are just waiting there until it goes above the short call strike price. But if you get that 5 points back, it's an additional 5 points into the additional gain you've made on the stock itself. All right. Let's see. Ben's question. We're going to go a little bit over. It's 5:30. I have at least two more questions in there. Ben's question is, Michael, how do you fix this trade? Bought Apple at 230. Apple tanked to this level. Okay, without even looking at it, I'm going to say the same concepts apply. Take a look at the stock repair tool for Apple. See if there's anything available. If not, I might want to take a look at some of those other ideas in the webinar we pointed to. Remember, on the webinars page, go to Options Concepts and then Manage Your Broken Position. Cost per share 230. Let's just say 100 shares to keep the math simple. We're down to 170.42. No credit repairs available for the near months. Okay, none there either. I don't want to say put in more money to this position because I don't know your financial stance, but this might be a good idea to average down to see if you can get it. So if we buy at 170 now, you're going to end up with a cost basis of roughly 200. Okay, so you have 200 shares at $200 average price. I know it's expensive. I don't know how many shares you started off with. But see, now there's some repairs. They're far out though. So maybe in that webinar I also discussed maybe ideas of maybe just selling some premium against it as a covered call in that sense, or trying to do some other strategies near term to get you to a better cost basis where looking for a repair might be beneficial. But it's not too bad. It's so far out in time. I don't know if I would do this one, but it does lower the break even to 183.03 and 184.73 in this case as well. If it's that far out in time, I may just consider selling near-term premium against it, but being very careful with the management, not letting it go in there as well. Ooh, great question. This is related to the radioactive trading concepts. This comes in from Jerome. Okay, and we're talking about the married put positions where we buy stock and we buy a put option that's several months out in time. And we use the 12 different income methods discussed in the blueprint to lower that initial low risk, generate income to increase profits, and potentially get to a point where we're bulletproof on the position and have no risk and still unlimited upside going forward. Now, Jerome is saying that he just started buying married puts a couple weeks ago. This week, 4 of the 5 that he purchased went up past the initial put strike price. And so you went ahead and did what's called income method number 4, and all of them cutting the risk down by half. Okay? Was there another income method I could have used knowing that I would not have access to my account for the next 2 weeks while on vacation? Income method number 4 is the best one to use in the situation you're describing, especially if you're not going to be around. What is income method number 4? It's the advantage of using the put option, even though it's lowered in price. Sorry, here we go. I don't know if I have my position in here. I hope I do. Oh, we've got a couple good ones in here. No, we don't. Okay. All right, so let me just go this way. I'll enter one that's close to what I'm in right now, similar to what we used for the covered call example. Rather than the covered call, on January 24th, could have bought 100 shares of stock at $64.75 and probably bought a June, yeah, it would have been a June, $67.50 put on, again, the 24th. And so let's see, we're $3.57 in the money, or I'm sorry, $3 in the money. Let's just call it that, plus an additional $2.50. So let's call it about $5.50 would have been the cost. Maybe higher. If the risk should be about 4.5%, 5%. Let me take a look here for that Starbucks position. Anyway, what I'm going to do here, Jerome, is we're going to take this Starbucks. Oh, okay, so it's got to be higher. All right, it's got to be a little higher. Let's put it up at 6.25. Nah, 6.35. Okay. That's about right. Maybe a little higher. But okay. Here we are at a risk of 5.1% for a position that was several months out in time. Okay. And so the stock has now moved up above my put strike price, and it's continuing to go. Now, income method number 4, what happens is, did I lose money on the put? Yes. We got into the stock at $64.75. It's now trading at $70.71. We've gained $6 on the stock. I paid probably $6.35, $6.85 for the put, but it didn't go to zero. It's still 120 days out in time, 125 days out in time, so I've still got a value of about $2.30. Why is that important? Because I can sell to close this for $2.30 and buy to open the 72.5 for about $4.30. I'm going to pay $2 roughly to gain 5 points of guaranteed insurance. It's almost like generating $3 in premium. Let's take a look. So I'm going to sell to close my $67.50 and buy to open the $72.50. My original risk, remember, was 5.1%. Yeah, we're paying right about $2 to gain 5. My risk drops down to nothing. Yes, I'm holding a 72.5 put. Yes, I increased my cost basis, but remember, this put isn't at zero either. It's still at $4.35. I could still sell this at $4.35 and sell the stock at $70.71 and be at about the same return I was before I rolled it. Why do I say this is still one of the best income methods to use? Because if you're still not going to be available to watch the screen, you've nearly canceled all the risk on the position, and at the same time, still have unlimited upside if it continues to move up. Now, what you could do on top of this is another income method, not just sell a call which caps the upside. Let's go 21 days out here. I'll sell the 71. I like that. And buy the 73. Why am I doing those two numbers? Because remember, my risk was still about 58 cents. So I'm going to get about $1.10, and I'm going to pay 40 cents here. So we're going to get about 60, 70 cents a premium. But instead of just selling the 71 call, which would cap the upside, it would bulletproof the position, I'm going to buy a 73. I'm going to do a bear call spread. But in the context of owning the stock, now I have to do this a little differently. Let me clear these two out. I'll just call it $2, okay? Oh, wait, 4. That's 4, I'm sorry. Okay, so we're still going to have that nearly 0.8% risk. I'm going to generate another 80 cents. There we go. Now I'm bulletproof on the position, and I still have unlimited upside profit potential. Even though I sold a call, I left it open. Now we could go back and say, well, why didn't I just do that from the beginning instead of adding to the cost basis by maneuvering the put? Because then I don't get that $3 advantage of only paying $2 to gain a $5 higher payout. So if you're not sure, if you're in a married put position, the stock has moved up, you're not sure what it's going to do next. You're not going to be able to watch the positions. Using income method number 4 to roll up the put and take out most of that risk, or at least half of that risk or more, is the right approach, and then you can come back later and see where you are. Because I still have 120 days. If it drops, I can manage it at that point when I come back from vacation. If it goes up, I can decide to close the position or roll this again and have better bulletproof status. This gives you a little bit more oomph. It gives you a little bit more income, this nested spread trade that doesn't take on any risk. Income method number 6. But let's go back here. Doing that from right off the bat with a cost basis of 64.75, and we originally had the June 67.5 put, and I said that was at 6.35, roughly. I'll do that in the middle. See, doing that income method number 6, selling the 71 and buying the 73, doesn't take out a lot. We did get a good credit, but it doesn't take out a lot of a risk. The best risk reduction in this scenario when the stock has been moving up is income method number 4. You're okay paying the debit because you're getting a much higher guaranteed exit, much higher guaranteed payout as the worst case scenario. 4 and 6 are really good because it leaves, as a combination, Jerome, because it leaves the upside open and it takes out most of the risk as well. So that's one of my favorite things to do if I'm in the right situation. Other income methods are probably not right at this time. They could be used, but I don't want to go into them. But that's the advantage. See, even though the stock went up 6 points, I did lose on my put. And I lost maybe only 3.5 points, maybe a little bit more. But I can still use that time value that remains on that put to get a higher strike put, 5 points higher, but only add about $2 because of what I'm getting back. The original cost of $6.35 is already factored into the cost. So this allows me to move it up, manipulate the put, which is actually a second working asset. It's not just an insurance policy, and put myself in a proper position to have very limited risk. And if the risk is this low, then I can just bulletproof it with that bear call spread, income method number 6, to generate some premium to bulletproof and leave the upside open. One of the risks of income method number 6, let's go back to that again. With just the stock, let's look at it with just the stock. We know it would bulletproof the position here for what we're going to do. The bear call spread on top of the stock. It leaves the upside open. But one thing to keep in mind, Jerome, in this scenario, you have a married put here, so it's a little bit different structure. But if the stock is trading in here and you're not watching it, it's at 71.50, 72, 73, you can get assigned on the stock where you would just, and the long call would expire worthless, and you would just be left with the long put. Okay, so you'd want to pay attention to that even if you are on vacation. If you did income method number 6, that's one of the drawbacks. You still could risk being assigned on the stock if it moves up above this strike. If it moves up above both, okay, if you're in this bear call spread in the nested stock position, it's a riskless bear call spread. You don't have to put up the margin because it's really just a covered call with a long call you received at a credit. But if it shoots up above, rather than assign your stock, what your broker is going to do is maybe buy shares of stock for you at 73 to sell at 71. So you would take a $2 loss. But if stock's up at 74, it's $4 higher than when you got in. So that's still a benefit. And you took in that credit of almost 85 cents. So you could say, oh, well, you're losing on the spread. In order to lose on the spread, I have to gain more on the stock, which I would still own. Okay? So that's the idea. Okay. And Mark. Mark says, to the extent you're able to respond, generally speaking, let me take a sip. A little sip of ginger ale there, excuse me. To the extent that you're able to respond, generally speaking, can using the married put bulletproof methods be workable and effective, meaning not a terrible idea, with highly volatile stocks like Tesla or others? What cautions are there generally about volatile stocks with this method? Great. I can answer that. The married put techniques can essentially be used on any stock that you feel is bullish in price. We have our preferred approach we talk about in that full work, the blueprint, of how we select stocks and our risk threshold that we look for. In other words, Mark, any married put position I would open today, following the radioactive trading techniques, which, usually I have about 40 to 50% of my trading account allocated to this strategy. I want this one. I'm going at least 150 days out in time for protection, and I'm going to keep my risk somewhere between 5 to 8% most of the time. Okay. Nothing here that's around the same price, but let's just take a look at VIV. VIV's been kind of moving, not as volatile as Tesla, but the stock's at 120. I could go 10 points in the money with a January 130 for an expensive price of 21.80. Now, this does make my cost basis 142.61, but because I have the 130 put, the most I can lose is 12.60. And that happens pretty much only if I hold the position all the way to January 2020 expiration and make no adjustments, and the stock is below 130. That's usually the only time I'll take this risk, because tomorrow, this put option is going to be worth 21.70. If it moves up 2 points, it's still going to be worth 19, so it's going to have a lot of time value left. So how is it different using a more volatile stock? I want to take a look at something here. Max risk is 8.8%. Interest earnings date. Oh, I don't have it. It's okay. I'm just going to link to it quickly. Oh, the other thing I was going to mark, I'm just looking at the option here. I want to see something. I want to see just the range in the money. Yeah, it's 8%, 7.7% in the money. Okay. For 330 days. Let's go to the search by symbol tool for the married puts. So I'm sorry, 7.7% in the money, roughly 8.8% at risk for 330 days. Now, Tesla, let's go to January and let's look at maybe more results. Okay. So with the stock at 305, I'm sorry, my apologies, stock at 307, I'm probably at the 315 range and maybe 320 to keep that same range in the money, and now you see the problem. It is more expensive, more volatile. That means the risk is higher. Absolutely. So there's a trade-off here. In general, Mark, I don't like going more than 15% in the money. But in order to get the risk of 7 to 8% on a position like this, I might be going very deep in the money beyond what I'd want to see for this strategy. However, if I'm very bullish, let me just add in the range in the money here. I'm sorry, I clicked the, you're not seeing, I clicked the add more columns button because I want to stop hovering over things. I want to see my range in the money, in and out of the money. There we go. I'm going to change my column order very quickly just so we can have it near the maximum risk. All right, so let's customize that and let's refresh our page. Good, good, good. All right. Okay, so you see here, to get the risk I typically would want for the married put, my range is here. About 5, really about 4.7, but I'm 33% in the money, 29%, 26%, 23%, more than I normally go. So the caution is that you have to potentially go deeper in the money in order to get the controlled single-digit risk in your favor. Why is that necessarily a bad thing if you're bullish on the stock? It just means we need more movement, right? I'm up at the 390, 380 strike here. I need a $70, $80, $90 movement before it makes sense to start doing some of the income methods, which are best done when the stock is at or near the put strike price. Going only 7, 8% in the money is not too bad on Tesla. You're still taking just a 12.5, 13% risk. It's about double of what I usually like to take. But if you're right, and the stock does move 6, 7, 8, 10%, you're going to be able to manipulate this, cut this risk in half, still the whole time. Well, if the the puts are too expensive that are far out, guess what? The calls short term are going to be inflated as well. So you'd be able to use that income method number 6 and get a good premium on it to help reduce the risk while leaving the upside open for wild swings. Cautions: to keep the single-digit risk, which is the main benefit of putting the market odds in your favor with the radioactive trading techniques, then we're in the proper place. But we had to go almost 30% in the money to do it. You could go with the normal range in the money we like to go, 10, 12, 15%, maybe 8% in the money, but you're taking on risks of 13, 14%, maybe double. But that also means you'll have the ability to get more premium for some of the income methods going in. On your comments there, Fernando says, it's just as I was talking, he says, sorry, I have a married put in Tesla that goes very well. The married puts make you confident even if the fluctuations have been very high. He says, I've applied more than one time income method number 4 and that income method number 6 to generate income and leave the upside open. Okay, so it's good, and it can be done, but you're going to have to decide which approach is better for you. Are you comfortable taking the higher at risk on the more volatile positions, being in that 10, 12% in the money range, or would you go deeper for only the 5 or 6%, realizing you need a larger move in order to? I think Fernando started off more in the money with Tesla with risks of around 8 and 9%. I don't think he was in the 13, 14% when he started the trade, but he's been able to adjust, as he mentioned, and use the different income methods to lower the risk on the positions as well. All right, so that's my thoughts on those. Any stock that you're bullish on as well will work for the radioactive trading techniques, the married put techniques, to stack the market odds in your favor. And of course, remember the full technique and all 12 income methods we use, in addition to the initial structure, which puts the market odds in our favor, are discussed in the blueprint. You can just click on that here, go to the storefront, look at the blueprint there, to see what special offers we have right now as far as the bonus offers that are available with the blueprint. Why are there 12 income methods? Well, some work best if the stock moves up, some can be used if the stock stagnates, and some are best used if the stock falls in price. So in different market conditions, I'm going to use different adjustments. The ones we talked about today, 4 and 6, are basically used when the stock moves up, or if you're expecting a large move and you want to generate some premium but leave the upside open. That nested bear call spread, where you don't have to put up the margin for the spread position because it just looks like a covered call with an extra long call. You don't have to add anything. You keep infinite upside on the protected position and generate premium to lower the cost basis and the risk as well. All right, well, I don't see any other questions coming in, ladies and gentlemen. So with that being said here, let's just go ahead and try to shift back over here. No, let's just do it this way. And that's wrong again. That's okay. Okay, I just wanted to remind everyone that today's materials, of course, are my thoughts on your questions, designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions, but the concepts of what we have shown show us how it is possible to manage positions different ways and adjust positions in different ways to help the position, to help lower your loss on the position, potentially get back to break even, and of course we have the tools available to help you fix a broken covered call, a broken stock, quickly evaluate rolling covered call positions that move quickly against you, and the benefits of limiting risk, not to mention using those adjustments there to help you further lower that risk as well. Options do involve risk, may not be suitable for all investors, but we're going to do our best to keep things in your court and in your favor so that you can be successful. And remember, the markets are closed on Monday due to President's Day. It's not the 19th, I believe it's the 18th. Just trade entry wrong there. Trade entry. Numeric entry incorrect. All right, now for those of you who haven't done so yet, remember at any time you can test out the tools we showed today, the portfolio tools for the rollouts with the Starbucks covered call, the stock repair tool, the search tool for any of those strategies to find your positions, including the collars, the calendar collars, and more we discussed. Just go to powerup.com, put in your first name, last name, and email address, and you have a full trial for 14 days. Beyond that, the subscription levels start at $40 per month. Then they do go up. We offer an end-of-day service at $40 per month. Then the 20-minute delayed service where the data is updated every 15 minutes or so, that's $60 per month as well. We do offer full historical access with data going back to April 2006. Other free education, remember, check out the blog. Ernie's got that article up there on a covered call on Vive that we just put up recently, as well as other structures and other white papers. As mentioned, you can go to the webinars page at any time. Take a look at that webinar under the options concepts of managing a broken position if you've got a covered call or a long stock or even a naked put was put to you that's been declining. The ideas on rolling covered calls, that was in the option strategy section. There's also webinars on rolling credit spreads, adjusting credit spreads, rolling naked puts, and more. And then, of course, that quick 15-minute video on the Starbucks roll we evaluated and looked at today. You can always check that out on YouTube, as well as many other archive videos. Well, ladies and gentlemen, thank you once again for joining me today. Thank you for your fantastic questions and the spirited discussion. Remember, if you think of any questions later on, send me an email anytime to support@powerop.com. You can also ask questions to support@radioactivetrading.com as well. During market hours, we probably might not be here on Monday, but on Tuesday, Wednesday, Thursday, you can always call us during market hours at 302-992-7971. Remember, if you are on a current trial or you are a subscriber, you can schedule a coaching session at any time, and that's essentially a 45-minute conversation with myself and Ernie. We'll walk you through the tools on the site and answer any questions that you have. All right, so Charles says thank you, and Rainier says thank you as well. Thank you for joining us today, everyone. Again, thank you for your questions. I look forward to seeing you guys, anyone, guys and girls, next week for some of our other presentations. I'll get this webinar converted and hopefully get it posted to you by Monday at the latest. So you'll see that available, and you'll be able to check it out on Power Options and on YouTube. In the meantime, take care. Enjoy your extended weekend. We'll see you soon.